Hi, this is Michael Yardney and welcome to my fortnightly property market update. There's been good news this week, hasn't there? On the first Tuesday in September, the Reserve Bank cut interest rates for the first time in 7 years. The cut of 0.25% is likely to be followed by another one of a similar size later this year. What I'd like to do now is spend a couple of minutes discussing what this rate cut is going to really mean for property investors like you and me. Putting things into perspective, this will be the first cut in official interest rates since December 2001, and this marks a historic shift in our economic cycle. A family with an average mortgage will be about $32.50 better off a week, and with another cut likely later this year, that's probably going to give them a $65 boost. If you throw in the tax cuts from the May budget and lower petrol prices, it's very likely the average family should be about $135 better off at Christmas time than they were in the middle of this year. Okay, so what prompted the Reserve Bank to change their tactics and start cutting interest rates after 12 successive rises? We know the interest rate increases that we've had over the last few years was because the Reserve Bank was concerned about inflation, which of course has increased to over 4% in the last couple of years. But more recently, consumer sentiment has dropped, lending for houses has fallen, and generally spending has crashed. At the same time, the global financial crisis has forced Australian banks to lift interest rates even higher than the Reserve Bank's rates increases. This, plus the stock market crash, has made you and me, Australians, feel poorer. Our economic slowdown has obviously been concerning the Reserve Bank even more than the rise in interest rates have been affecting them, hence the cut in interest rates. The Reserve Bank is predicting that our economy just won't be able to create enough jobs for our growing population, and this will cause a rise in unemployment. Obviously the Reserve Bank wants to avoid this, as a rise in unemployment could lead to mortgage foreclosures and small business failures. When our economy slowed down in the past, the Reserve Bank has always come to the rescue. You may remember this happened back in late 2001. If you think back, the dot-com share bubble burst, and then September 11th terrorist attacks shook the world, and at that time there were similar fears to now that we could fall into recession. The Reserve Bank responded quickly, slashing rates by 1.75% in just 16 months. Thanks to its efforts, the economy had a classic soft landing, and hardly anyone noticed the blip. Okay, back to my original question. What does this mean for property investors like you and me? You see, the Reserve Bank wants to slow our economy. It's part of its plan to drive back inflation back into the 2 to 3% band where the Reserve Bank wants it. That's why it's unlikely the Reserve Bank is going to drop interest rates more than twice in the short term. It's going to drop it once now, as it has, and then again later this year, and then pause to assess the impact of those cuts on the developing state of our local economies and to see what's happening in the international economies. You see, the Reserve Bank wants our economy to slow, but not to go into recession. It wants most of the slowing to come from you and me cutting back on our spending. Over the last months or so, at Metropole, we've noticed many of our major property investor clients coming back into the markets. They've been anticipating this fall in interest rates and wanted to get ahead of the pack. On the other hand, many beginning investors are delaying their buying decisions, and they're going to wait even longer for interest rates to fall further. At my upcoming Understand What's Really Happening in Our Property Market seminars, top-selling author and property tax accountant Ed Chan and I will be explaining how all these factors will interact together to create some challenges, but also some great opportunities that savvy property investors will be able to exploit if they understand the new rules for this new property market. So click on the link below now and find out more about this last round of seminars that we're going to be conducting in 2008. And come and join us so you can get into the property markets ahead of the crowd. Okay, back to my question. What are the interest rate drops going to do to our property markets? Michael Matusik, who's a great property researcher and director of Matusik Property Insights, recently analysed how interest rate falls have affected housing starts, property values and consumer confidence since the early 90s. His research concluded that 0.25% interest fall, in mortgage interest rates of course, caused the following. Number one, it caused housing starts to rise. People started building houses, and the housing starts rose about 5% over a 3-month period immediately after interest rate drops. House prices also rose. They rose 2 or 3% after the interest rate drops. It took about 3 months and house prices started to rise. Sales volumes lifted also, about 5%. In other words, more properties were sold after the first quarter, after a 0.25% interest rate drop. And understandably, consumer confidence lifted. Matusi concluded it increased about 8% within a month or two after declining interest rates. Putting all this together, it suggests our property markets are poised to turn. Of course, you can't just buy any property. Some properties are going to outperform others over the next couple of years. In particular, properties close to infrastructure, close to the CBD, close to water, they're going to perform better than those in the outer areas, which I think are still going to be hurting for a while longer because of relatively high interest rates and petrol prices. So to help explain my thoughts much more clearly on where the property markets are heading over the next few years, what to buy and what to avoid, what I'm personally going to be buying and the areas I'm going to avoid, I'm going to be conducting my Understand What's Really Happening in Our Property Market seminars with property tax accountant Ed Chan. We're halfway through this series of seminars around Australia currently, so please click on the link below because this is the last round of seminars we're going to be conducting in 2008. I'd like you to come and join us. By the way, have you checked out details of my annual Real World Real Estate Workshop? It's Australia's longest running 3-day advanced property workshop. It comes with a 6-year proven track record and my personal guarantee. So if you're an advanced investor or a well-read beginner, and particularly if you want to get started in property development, if you want to understand how to get started in property renovations, plus understand much more detail, come and learn from real-world experts. Come to join us in October. Click on the link below and find out how to take advantage of the early bird specials. For the last 6 years, this event has always sold out, and this year will be the same, so join us at my Real World Real Estate Workshop.